Hello and welcome to a new virtual investment summit by Fund Society. Today we're talking about high quality fixed income, and we will do so through a live interview with Matt Jakcson, who is part of the Western Asset Global Credit team and portfolio manager of the Legg Western Asset Short Duration Blue Chip strategy. As you will probably know, Western Asset is part of Legg, which was merged almost a year ago into Franklin Templeton. As a result of this, Franklin Templeton is one of the world's leading asset managers with more than $1.5 trillion in assets under management. It is worth mentioning that half of these assets are in fixed income products. Franklin Templeton has a global footprint with offices in 34 countries around the globe, more than 10,000 employees, and over 1,200 investment professionals globally. Before proceeding, I would like to remind our audience, which today is joining us from several different countries in Europe and the Americas, that after the interview we will have a short Q&A session with your questions. You may post them through the Q&A feature available at the Webex Events app or sending an email to info@fundsociety.com. Finally, I want to extend a very special welcome to all the FPA members who are joining us from Spain. This session is valid as 1 hour of recertification for the following titles: European Investment Assistant, European Investment Practitioner, European Financial Advisor, and European Financial Planner. To gain this recertification, you have to pass a short test that will be available on the FPA Spain website from the end of this event until 10 p.m. Continental European Time on June 4th. And now I want to introduce our guest, Matt Jakcson, who has 20 years of experience and is part of the Western Asset Global Credit team. Hello, Matthew, and welcome.
Good afternoon. How are you?
So, Matthew, tell us a little bit about yourself. What is it exactly that you do in the Global Credit team at Western Asset, and how did you get there?
Sure. So I am one of several portfolio managers at Western, and my focus is on investment grade credit. So the portfolios that I specifically look after are global, European, and sterling-based funds. And really they range from the traditional benchmarked type portfolios to much more non-benchmark solutions, of which the blue chip bond fund is one. Now, as a portfolio manager, my ultimate responsibility is for managing the overall level of risk of beta within credit funds, and all of the other risks that we face as fixed income investors, such as duration risk, yield curve risk, currency exposures, the sectors, and so on, and really making sure that level of risk is appropriate and in line with our clients' guidelines and risk tolerances. I would say it's definitely not the case that I'm a one-man band, and I think a real hallmark of the Western approach is a team-based approach. So all of the funds that I look after are co-managed with Annabelle Rudebeck, who is the head of non-dollar credit at Western Asset. And we're really supported by and rely heavily upon a very large, experienced team of analysts based all around the world. We have dedicated traders who are not just there to execute trades, but also to provide market color and opinion. And then we have supported by portfolio analysts who help us with portfolio construction and cash management, almost like junior portfolio managers. And then, of course, we have quite an extensive risk management function at Western that is very closely integrated to the investment function, albeit with a separate reporting line. And they really help us with scenario analysis and stress testing, and really help us to understand, are our portfolios sufficiently diversified? are we taking enough risk or are we taking too much risk? And are our kind of key high conviction themes adequately expressed in portfolios? And as to how I got here, I actually joined Western 18 years ago, and I began at Western within the risk management function, and then moved on to become a research analyst, and around a decade ago moved to the credit side, where I've been happily ever since, managing global credit portfolios. And obviously that period of time, I've seen a lot. The financial crisis, obviously, the Eurozone crisis, the commodity volatility in late 2015-16, and then, of course, the most recent COVID crisis that we've seen. So no shortage of crises during my career, and thankfully still alive today.
That's great to see. As a matter of fact, just for our audience to know, Western Asset is an asset management firm which is focused exclusively in fixed income. Is this right? Yeah,
that's correct. I mean, we often say that Western's one of the biggest asset managers that not many people have heard of. At Western, we manage just shy of 500 billion in assets, and as you rightly say, that is all in fixed income. That is all we do. Actually, an interesting little fact. So Western Asset was founded in 1971. So this year we're celebrating our 50th birthday this year. But yeah, across that 500 billion, about a quarter of those assets are in corporate bonds. But we have pretty deep expertise in all flavors of fixed income, be it munis, inflation-linked, emerging markets, and so on. We've got the full range of fixed income well covered.
A lot of very interesting things happened in 1971. NASDAQ market was also founded there. After almost a year of integration with Franklin Templeton, what has changed in your day-to-day life?
So, there's obviously been a lot of change over the past year, but it hasn't really been because of the Franklin Templeton acquisition. Obviously, the big change has been working from home with COVID and the challenges and opportunities that's presented. But as far as the Franklin acquisition goes, I can honestly say as a portfolio manager, it hasn't impacted me directly at all. There's been no impact on our team, on our process, on our platforms, and we retain complete autonomy and independence from an investment point of view. Less directly, I would say there has been a couple of impacts, both of which I'd regard as positive. The first is clearly Franklin. We benefit from a much broader, a much deeper distribution network. So, our funds are now being marketed in countries, in parts of the world that we never really had a presence before. So that's certainly been of benefit to us in terms of gathering assets into some of our funds. Secondly, I would say just, Franklin, an incredibly strong parent financially. We have access to a much stronger balance sheet. And therefore, when we have new ideas for funds and we're looking for seed capital, that's just a little bit easier today than perhaps it has been in the past. So, certainly no disruption and a couple of positives away from the investment side.
Yes. Okay. So now let's move into the market outlook part of the interview. We have to talk about inflation, of course, which has become the number one risk for investors. What is your view on inflation?
Yeah, you're right. It's the first question in any meeting I do these days. What do you guys think about inflation? We clearly have seen a meaningful pickup in inflation numbers and in inflation expectations. So I think the big question for investors today is, is this transitory, to use the Fed's favorite word, or is this going to be something more permanent. And I really think whatever side of the debate you fall on, I think you have to acknowledge that there's a huge amount of uncertainty either way. You know, on one hand, we've never before had this kind of COVID shutdown shock and sharp, brutal hit to the economy that we saw last year. But on the other hand, we've never really dealt with a wide reopening, and not just reopening, but reopening with massive amounts of fiscal and monetary stimulus behind us. So huge uncertainty, I think, is the appropriate way to look at it, rather than being too dug in. As far as our view at Western goes, you know, we actually find ourselves in the rare situation that we kind of agree with the Fed on this one. You know, we are leaning towards the view that inflation, this inflation that we're seeing, will indeed prove to be transitory. And I think there's a few reasons for that. Yeah, first and foremost, I think you have to acknowledge that base effects and supply disruptions that we've seen because of the shutdowns and the messy process of reopening have certainly contributed to a very large extent to this rise in the inflation prints that we've been seeing. And over time, we'd certainly expect you know, the supply side of the economy to catch up and things to come a bit better in balance. Secondly, I think, you know, we look at just thinking about the jobs numbers. There's still, for example, 8 million less Americans in employment than there were pre-pandemic. We look at the devastation that's happened in small and medium-sized businesses, enterprises. So, you know, we think that there is still quite a high degree of slack in the economy. You know, I think when we talk about inflation, what are we talking about? We're not just talking about a one-off rise in the price level, and that's really what these supply side disruptions and the base effects are. They are one-off, and for inflation to truly happen, it needs to happen again and again and again, and we just don't see that happening. And then we think about, you know, why has inflation been so low for so long? And there are some real long-term drivers of that to our mind. You know, aging populations, technological advance, very high debt burdens. You know, those issues are still with us and will still be with us. And when we think about some of them, like high debt burdens, you know, those issues have got worse, not better. So we certainly acknowledge inflation has gone up, but we're very much of the opinion that the Fed's got the right call here, and we will see inflation pressures really come off next year.
And what about the European Central Bank? Do you think that they're approaching this inflation problem or lack of inflation problem in an appropriate manner, or are there differences with the Fed?
No, I think, you know, in a nutshell, all the central banks will, in our opinion, remain very accommodative for some time. I think they're all of the same mindset here, that it would be, you know, incredibly dangerous to do too little or withdraw policy too early, and they're happy to let inflation run a little bit hotter in the near term, rather than panicking and withdrawing that accommodation. So, yeah, I think policy, they're going to remain, you know, very forward, or very you know, transparent, give us a quite good forward guidance as to what they're thinking and their intentions. But for now, I think the policy stance that we've seen of you know, keeping policy very accommodative and not talking about hiking rates or tapering imminently is the right way to go.
Okay, so today, talking about credit, we see that credit spreads at the lowest levels ever, mostly. What is your outlook for credit?
So this is the other big question, and I think hopefully it's reasonably obvious from what I've said so far. I think it's fair to say we're quite optimistic about the world, about the outlook for growth looking forwards. We're quite sanguine on inflation. We don't see it being a big problem, and we're quite positive that the central banks are going to remain very, very accommodative and friendly. And all that should really remain a very kind of supportive backdrop for risk assets, including credit. But I think the problem that we have is that risk assets and credit markets are incredibly forward-looking. And as you rightly say, you look at spreads today, and in many cases, and certainly on an aggregate level, spreads are tighter than they were pre-pandemic. So while we're positive on the world looking forwards, I think we always have to come back to what's in the price. And I think the price today does really reflect quite a Goldilocks scenario of growth picking up, inflation not being a problem, central banks remaining supportive. And there are kind of risks to both sides of that. The economy could really disappoint and inflation could come off and growth could disappoint. And is that a good situation for credit? Perhaps not. Alternatively, the economy could run too hot, inflation could get out of control, and central banks could really have to change their message. And could that trigger some kind of taper tantrum scenario that upsets risk markets? So, when we look at spreads today in investment grade, I think it's fair to say we're a little bit cautious, and generally the direction of travel in our strategies and our portfolios has been to reduce risk, to get down or reduce lower rated credit into higher rated credit. Just like spreads are at kind of the tightest levels that we've seen in some time. Also, that compression between triple Bs, say, and single As is also looking pretty narrow. So, certainly thinking here that valuations reflect a lot of the good news, don't offer you huge compensation for unforeseen events or things going wrong. And quite cautious on the overall level of risk in portfolios here.
So let me see if I'm getting right your view. What you're saying, it's not that there's like a big risk of default of companies because the economy is going to go south, but it's more a perception of the market that they are like in a very enthusiastic place about everything, and there could be some hiccups in the way, and that's why you are talking about going into higher quality credit. Is this more or less what you're saying?
Yeah, exactly. I mean, I think over the next 6 months. Actually, step back. I think one of the biggest surprises for me this year is that we haven't seen more volatility in risk markets. We have seen huge volatility in the rates markets, obviously. We've seen quite a bit of volatility in the equity markets on occasion. But I'd say credit has been pretty much a flat line this year. Very, very little volatility in spreads. And a big surprise for me has been, given the volatility we've seen elsewhere, that we haven't kind of had any moves in credit spreads really. So, I think looking forwards over the next 6 months, I think this debate about inflation, this debate about the central bank response, will they, won't they taper, is very much going to be with us, and I could see that potentially. Giving rise to some bouts in volatility in the credit markets. So we want to have some dry powder at the moment, and we prefer to reduce credit risk or go up in quality in credit.
Okay, so now let's talk about the strategy you manage, this short duration, high quality strategy. Tell us a little bit about how it was created and when and why.
Yeah, so actually we've been running this fund for a very long time. Interestingly, it was launched in June 2009. So, it was almost a reverse inquiry. a client came to us and said, we recognize that credit spreads are attractive here, but we're still a little bit scared after the financial crisis. So we want something that only invests in real high quality credit, doesn't invest in the kind of problem sectors of the market at that time, obviously subordinated financials, emerging markets, and lower rated credit very much under pressure. And we just want to harvest a kind of defensive credit risk premium that'll do us better than being in pure risk-free assets such as government bonds. So we've got a kind of 11-year track record of running the fund now, and I think that was how the fund came about, and it's been interesting, the evolution in demand. So I'd say the fund certainly a few years ago with rates low and risk appetite quite high, and I fell out of favor a bit. But really over the past couple of years, we've seen quite substantial growth in assets within the fund. And I think that has really come from investors who have been forced out of holding cash. As a European investor, your custodian might charge you 75 or 50 basis points for sitting on euro cash. And so that's forced people to look at alternatives to cash that are very low volatility, very defensive, conservative. And this fund has benefited from that.
I see. What are exactly the investment guidelines? What's the investable universe? Is it a global fund? How do you manage the currency? Tell us a little bit about the details.
Sure. So the key parameters of this fund are firstly with regards to credit quality. Anything that we buy in the fund must have a single A or better credit rating. We don't invest in anything that is subordinated. We don't invest in any structured products. We don't invest in any emerging markets. The overall duration of the fund is kept between 2 and 4 years. And I'll come on to the reasons for that in a bit. We do invest globally, so the assets are in US dollar denominated assets, euro denominated assets, and sterling denominated assets. And that actually gives us quite a big opportunity set. A lot of people talk about how triple Bs have become such a large portion of the market, and then they ask the question, well, does that mean you struggle for things to buy in single A or better? But that's not the case at all. Yes, the weight of triple Bs in the credit markets has gone up, but let's not forget that the credit markets themselves have grown massively over the past few years. So there are more single A rated issuers today, more opportunities for us to invest in than there were 10 years ago. With regards to the currency, because of the volatility that's inherent in active currency positions, all of our currency exposures are hedged back to the base currency of the fund, and we really derive our return from active duration management, active credit beta management. Obviously stock selection is key, avoiding losers, avoiding names that get downgraded and see spread widening and so on. And I think also another source for us of value add is definitely that ability to allocate to the different currencies. Thinking back to March, April of last year, it was US dollar credit that really underperformed. In Europe we had the ECB containing spread widening in euros. The US didn't have that at the time. US dollar credit was very, very cheap, and we could aggressively add to US credit in that sell-off that we saw in March of last year.
I see. And what type of clients are interested in this strategy? Is it more like institutional, or are you getting more from private bank clients? And geographically, I have to guess that most of the clients are in Europe, most of the investors?
Yeah, that's correct. I mean, So I say Europe and UK are the lion's share of our investor base, and really I think it's come from two areas. There's either people in cash, and as I mentioned, it's not a great time to be holding cash at the moment, given negative rates in Europe and so on. So people just looking for something that can give them a bit of yield, some positive return, without necessarily delving off into riskier parts of the market. And a lot of investors are required to maintain some average credit quality, some portion of liquidity in their fund, and this fund certainly would be consistent with that. I think we've also seen investors coming down the risk spectrum. So people who want to de-risk portfolios, perhaps they've got a lot in equities or higher risk credit, recognizing that valuations reflect a lot of good news at the moment, and want to come down into the risk spectrum. I'd say it's more typical that this fund is used as a building block within portfolios, either to temper volatility at an overall portfolio level, or ensure that there's a good liquidity profile to the fund.
Okay, so given your market outlook, what's your positioning in the fund right now?
Yeah, so I mentioned earlier that the fund can operate within a 2 to 4 year duration range. Thankfully, when the big rate sell-off came, we were certainly towards the bottom of that range, and we have increased duration a little bit, and we're now at about 2.5 years today. So I think this speaks to our view that as I said, inflation fears may be a little bit overdone here, and we expect to see some stabilization in rates as the market comes round to that view. Also, I think another reason for carrying a little bit of duration here is, when 10-year notes are at US 10-year notes are at 50 basis points, as they were briefly in August of last year, they arguably don't offer you a lot of protection in a risk-off environment. Whereas when you have 10-year yields back at 1.6%, if there is a disappointment to growth, if there is disappointment on the inflation side, or more bad news on the virus, duration now can actually offer you a bit of protection in a portfolio which has got credit assets in it. So I think it's fair to say we've been better buyers of duration at the moment. As I mentioned, with spreads looking a lot more optimistically priced than we were, certainly than we were in March of last year, and pre-pandemic. Now, our bias has been to get credit risk down in portfolios, and one way of illustrating that, at the moment within the blue chip fund, we hold around 15% in government bonds, which is quite a high allocation relative to where we've been historically. But a couple of good examples of deals that we've seen recently in the primary markets at new issuance. We had Amazon a few weeks ago did quite a large deal in the dollar market, and they printed a 2-year bond at Treasuries plus 10 basis points. So arguably you're not getting much compensation for any kind of credit event or default risk. Not that you necessarily would think that should be a problem with Amazon, but I think you're not necessarily getting any compensation for the relative liquidity between Treasuries and things like Amazon. So there's quite a lot of cases like that where spreads are pretty tight, and we're biased towards holding Treasuries instead of those kind of lines at the moment. I'd say in terms of the sectors, the fund is definitely most favorably positioned towards senior financials, banks in particular within financials. I think the story for us, this has been a real long-term view ever since the credit crisis, really, that banks have been on this journey of de-risking and building capital and shedding riskier parts of the business. And to us, the banks today look so fundamentally strong, arguably quite underrated by the rating agencies, and we're expecting to see bank upgrades in coming quarters. But I think a nice feature of owning banks is, when you think about in Europe in particular, the ECB buys non-banks, but it doesn't buy financials. So purely because of that central bank buying only of non-financials, bank credit looks good from a relative value perspective as well, to our minds.
I see. Okay, so just before talking about performance, I would like to clarify. You don't have any tips or any floating rate bonds, but you can have them. I mean, is it allowed in your investment universe? And well, I guess it's self-explanatory what you think about inflation and as to why you do not have them. But can you please clarify if you may have this type of securities?
Yeah, absolutely. We could own tips. We can and have done and own floating rate instruments. But yeah, as I say, we're a little bit more sanguine on inflation than the market at the moment. So actually, in some of our other strategies, our more macro-focused strategies, we've been shorting inflation, if you like. So we wouldn't certainly be a buyer of tips here.
Okay, perfect. And now let's move into performance. Can you tell us what has been the performance of this fund for the last 10 years, and especially how does it behave in high volatility moments of the market?
Yeah, sure. I mean, I should probably just clarify, what really this fund tries to do, and this fund doesn't run against a benchmark. We target volatility for this fund, and we target a volatility of between 2 to 4% annualized. And we hope that if we can deliver a Sharpe ratio of 1, then that should translate into returns of roughly 2 to 4% per annum. And it's funny, since inception, the return of the fund has been around 3.5% per annum. So with volatility closer to 2, so we've certainly delivered on that. I think back over the years, and certainly since 2011, which was a tough year for credit markets with the Eurozone crisis, and the fund did see negative returns. From that point on, which has seen a variety of kind of risk on and risk off markets, the fund has only experienced negative returns in one full calendar year, and that was 2013 with the taper tantrum. And even then, it was pretty modest. It was around 0.5% negative. That aside, the fund has delivered these modest positive total returns that we've seen, and I think that really comes down to the construction of the fund that will always have positive duration, as I mentioned, between 2 to 4 years, and will always have exposure to credit, to risk assets within it. So what we typically see is in a risk-off environment where perhaps people are worried about growth or central banks pulling away, and we see a bit of credit spread widening. That's typically been accompanied by a flight to quality into government bonds. So that positive duration protects the total return of the fund. Similarly, where we've seen rising government bond yields, that's been triggered around optimism on growth and inflation and so on, that's typically been accompanied by credit doing quite well, so offsetting that. I think it's important to understand with this fund and its objectives that if you're looking for 5 to 10% returns, this is not the fund for you. This is a very conservative fund that is looking for modest positive total returns a year in, year out. And with our long track record, I think it's fair to say the funds delivered fairly successfully on those objectives.
How about this year or this last month? What's been the performance and what do you expect going forward, like 6 to 12 months?
Yeah, I mean, this year returns have clearly been dominated by the rise in treasury yields that we've seen. So although credit has actually done quite well and delivered positive excess returns, the total return of anything credit related is likely to, or investment grade credit related, is likely to be a bit negative. So the broad credit market, for example, down something like 2.5% this year. This fund is down around 30 basis points. So I think the benefit of that short duration bias, certainly helping to protect total returns in what has been quite a short, sharp sell-off, particularly in February. In government bonds.
Okay, I mean, I have a couple of questions from the audience. We want to keep this short. We know that everybody is very busy. One of them is about the United Kingdom as an investable pool in credit. And maybe it's a little bit more long term because they're asking us if you see the UK benefiting from Brexit in the long term and UK companies as an opportunity to invest right now from a credit point of view?
That's an interesting question. I mean, we certainly did. Over the past few years, there's been the market's perception has unquestionably been that Brexit and a hard Brexit would be bad for the UK, and we saw for a while quite a substantial Brexit premium in prices. So UK domiciled credits trading much wider than European domiciled, and actually that has largely disappeared, that Brexit premium. So it's not so obvious that the UK represents a much cheaper or obviously better place to invest than other markets like Europe or the US. As to whether Brexit will prove to be a good thing or a bad thing over the longer term, I think the jury's still out. It's obviously quite an emotional topic for us in the UK and within our team, and everyone has pretty different, wide-ranging views on the topic, which I wouldn't wish to bore you with mine at the moment.
Okay, I have a very easy follow-up question. They're asking us if you have 15 or 50% of your portfolio in government bonds right now.
It's 15.
Okay. Okay. Just what?
In fact, the prospectus or the guidelines for the fund require that at least 2/3 of the assets are in credit at any one time. So, we could never be at 50% in government bonds.
Okay, great. So now just one last question, one last final thought. What does keep you awake at night from a market's perspective, if anything, regarding your strategy?
Lots keeps me awake at night, to be honest. I think that's the difference between credit guys and fixed income people. We're naturally worriers because when you invest in credit, the best that you can hope for is you get your coupon and your principal on time. But obviously the downside can be quite painful if you get something wrong. So I think as spreads get tighter and the world gets optimistic, we naturally in credit get a little bit more worried, and we try and think about, what should I be worrying about here? So I'd say the thing that worries me as an investment grade investor at the moment is perhaps the potential for more kind of single name event risk looking forwards. There's obviously a lot of private equity money out there at the moment. There's a lot of money out there from SPACs, and the danger is do kind of investment grade companies get LBO'd, which obviously could see multi-notch downgrades, big widening in spreads. If your bonds are trading above par, they may have a change of control at par, so you potentially lose several points in price. I think you're quite well protected for that within a fund like Blue Chip, where we do invest in the large large cap companies who in theory should be too big to be LBO'd. But there is also, even with large high quality companies, the risk that they themselves take actions that may not be bondholder friendly. They may decide that, why do I need to be single A? I could go and lever up, and I could give lots of cash to shareholders. It's okay to be triple B these days. That might be the kind of thinking. I think rather than when my conversations with the analysts today, I'm not saying to them, how much can this credit tighten? How much money can we make from owning this? What I'm asking them is what are the risks here? Could this company jeopardize its credit rating? Could it make a big acquisition? And really leaning on the analysts at this point in time to avoid the landmines, as we call it. I think as we go forward, and as what's been very supportive policy begins to get wound back a little bit, that could expose more credits, and so I think you just need to be careful and be kind of defensive here with regard to stock selection.
That's very interesting. So, Matthew, thank you very much. It has been very informative and interesting, and I hope our audience has enjoyed the strategy and will think about credit and inflation in a different way after this conversation. Thank you very much, Western Asset, Franklin Templeton, for sponsoring this program. And I hope to see you in the future, Matthew, maybe in England, maybe in Miami.
Hope so. Thank you very much.
Bye-bye. Thank you.
Bye-bye.